This is Agriculture Today. We are joined now by K-State and Washburn University School of Law professor Roger McEowen for this week's Ag Law Update. So, Roger, thanks for joining us.
Good to be with you.
Absolutely. So today our conversation's a little bit of a unique one. It's a conversation around, does using old tractors mean you aren't a farmer in the eyes of the IRS?
Yeah, this one is pretty interesting. And normally, Samantha, and we'll pick this up next time I'm with you, normally I would start out the new year with my top 10 developments of the previous year, top 10 ag law and tax developments. But let's squeeze this one in. This one is a head shaker. It's funny, but it's also sad because some farmer had to go through an audit with respect to this. But let me set this up. The facts are important to understand on this one. The taxpayer that got audited in this one was a farmer in southwestern Iowa. And he graduated high school in 1971 and bought his first farm in 1975. That was known as the home place. It had a 100-year-old farm home on it, so roughly 1875 was when it was built. Gets married in 77, moves his new bride into the old farm home with him, and that's where they lived and for many years. And his practice was to acquire land and equipment and tractors as he had the funds available. Now, he was working full-time as a route driver for UPS. And so what he would do, this guy was a hard worker. He would get up early in the mornings and he'd farm for a couple hours. He'd go do a shift for UPS. He'd come home, grab a bite to eat, and then he would farm, as the tax court explained it, farm till midnight. And he would do that day after day, week after week, year after year. And he had almost a 40-year track record at the time the audit occurred of doing that. He made it through the farm crisis of the 80s when a lot of other people failed. The tax court said he struggled, but because he didn't have debt, his practice was to simply buy as he had funds available and incur modest amounts of debt, but not much on the real estate. So he didn't lose everything in the farm crisis like some people that extended themselves too far did. And he made it through, and he kept buying tractors. He kept buying equipment. It was old stuff that he could pay for. He'd spend $500 for a tractor here, $800 for a tractor there. I think the most expensive one I saw in the list of tractors ever that he bought was an $8,000 tractor. And he said his reason was he didn't want to incur debt, and he wanted to be able to repair his stuff. By the time we get to the audit, he had 40 tractors. He had 5 tracts of land. He'd buy tracts as they came available, so they ended up being non-contiguous tracts, anywhere from about 6 to 14 miles apart, as the tax court explained it. And he would buy tractors and implements, and he would park them at his various farms, and they would have their individual uses. One tractor might be for cultivation, one might be for spraying, one might be for hauling manure, one might be for haying, and he'd have the associated equipment to attach and detach to those tractors. And so they're all spread out at these farms, and by the time we get to the audit, he has 40 tractors, 37 of which are at least 40 years old. And the other 3 are at least 35 years old. And you can read the opinion. It has the list of everything that he paid for them. And, of course, he's claiming depreciation and his fuel expense. He's writing off his repairs and all of that. He's taking his deductions, as a farmer would. IRS agent comes in and denies all of that on the basis that he's not a farmer.
Which is crazy because, Roger, what you just described, it sounds like this guy's been doing everything that you would hope to hear a producer doing. He's accruing very little debt. He's making the most of old equipment and fixing and repairing it himself. He's being efficient and smart about his decisions. And decades later of doing this and of building this repertoire, he pretty much has an IRS official say, no, for the first time, this is not allowed anymore.
Yeah, IRS got hung up on the fact that he did have a full-time off-farm job. He also had a number of pickup trucks that he was claiming depreciation on, and those were parked at his various farms. And the tax court judge said that he had suffered a heart attack, and so he would leave these tractors hooked up to their respective implements and the uses that he was using them for to save him time and labor. But IRS got twisted on the fact that he was working full-time on a non-farm job, but yet, as the tax court explained it, he's farming full-time too. I mean, he's working 2 jobs to do this.
Which isn't uncommon these days,
No,
right?
It's not uncommon at all. Sometimes you have a spouse that works, but he was doing it himself, managing all these farms and basically knocking himself out to do all of this. And it's what he loved to do. But the agent came in and said, well, obviously you're not a farmer. Nobody farms with this old junk. You're an antique collector.
Wow. How insulting, one. To say that, antique collector, but also how does this even happen, Roger? I guess that's my question is this IRS person comes in and there's obviously years of previous work that's been done with the IRS documenting all of this along the way. So this new IRS person comes in and says, no, everything up to this point, decades worth of information is wrong.
Well, I'm assuming it's a new IRS agent. We don't know. So I don't know that the agent is new, perhaps. And sometimes we see that with new agents. They tend to be aggressive to impress a manager and move up. But he had claimed a lot of depreciation, well, to the extent that the purchase prices allowed this. He did have some mistakes, and they dinged him on depreciating the pickup truck that he would drive back and forth to the UPS office, which he also used for farm purposes, but he didn't substantiate that well. And he had some substantiation problems, and that's a key point for farmers. Make sure you substantiate clearly your expenses and don't commingle your farm funds with your non-farm funds. So they dinged him appropriately on that, and that's part of what got him in trouble here. But this argument that, in the years in issue, he bought 8 tractors in 1 year, 7 tractors in another year, and 5 in another year. And I think we were up to around 20 tractors in the 3 years under audit that he had purchased in those years. But none of them are for very much. So there were some things that gave the auditor something to look for. But the argument that you're an antique collector, basically saying that you can't farm that way. That's not an acceptable way to be a farmer. The tax court judge had nothing to say good about that. I mean, she really squared the IRS away, said, no, you can choose the method in which you want to farm. And this was a method that she said he established to my satisfaction that worked for him. And he is a farmer. He's entitled to appropriate deductions. And so, again, as I said, he lost some with respect to one pickup truck and a little bit of depreciation that was not substantiated. But the point is, you can farm the method that you want to use to farm. And that's what the IRS was saying here. And it's the first time I'd ever seen that in my career where IRS said, you're using an unacceptable method to us to claim that you're a farmer.
Which is just bizarre. It almost has like a catch-22 or, dystopian kind of look.
Yeah, from a tax standpoint, this is one that you kind of close the book on as the auditor and say, okay, here's a few adjustments, but we're not going to push this to tax court. Here, accept these few adjustments, and that's it. But to bring up an argument that you're an antique collector and not a farmer, it's a new one on me. I've never seen that one before. And fortunately, the tax court judge said, that's not going to work.
Absolutely. And we kind of hinted at this earlier in the discussion, but this case specifically kind of brings to the forefront a bigger picture issue here with the IRS and agriculture with new agents.
Well, yeah, everybody's heard about that $80 billion of funding in the legislation that was enacted in August of 22. And I get concerned about that because $46 billion of that 80 is for enforcement. A lot less is going to go to agent training and upgrading computer systems and taxpayer services and IRS. The problem I have with that is while it's not a net increase of 87,000 agents, it's a net increase if they do all of this of about 37,000 because IRS is going to have about 50,000 people retire by 2030. The problem that I see with this and the problem I fear is, let's say they hire a net increase of 37,000. Those agents have to be trained. And you take the seasoned agents out of the field to train them, and then you put the new agents out there. Historically, new agents tend to be over-aggressive to try to impress a manager to move up the ladder. The last thing I want to see are more cases like this. That would be disastrous, and I hope we don't have that. I hope we have more agents that show up at the K-State tax schools, for example. They used to be there all the time years ago until the funding got cut. And that creates problems like this because education can solve this. This would never happen with a well-trained agent that understands, no, that's not the issue I need to be focusing on. I need to focus on the lack of substantiation in these things and button this thing up and be done with it. I just fear that we may see more of this kind of stuff down the road.
Sure, absolutely. And you discussed that the case was ultimately resolved pretty much for the producer, that, there's a few things that needed to be fixed just in general. But the issue here also is the stress, one, that was put on this producer that had already had health issues previously, and this might have exacerbated some of those issues through stress. And then two, just the time and effort that has to be put towards overcoming this as a producer.
Yeah. No one wants to get a letter from the IRS, let alone have to go through an audit. It's a traumatic experience. I dealt with an individual a number of years ago that went through 3 different audits. Every 3 years, the ranch was audited on the hobby loss issue. And there were no changes that were made the first two audits. The third audit, they end up in tax court on. And so they get a case out of it. But the end result of that was dealing with the IRS in 3 separate audits, a year or two of your life each time is consumed dealing with IRS in those audits. The end result was they finally just sold the ranch and said, we're done with this. And that kind of stuff shouldn't happen.
Yeah, that's just sad to think about. Well, Roger, I can't thank you enough for coming in today. You wrote about this subject as well on your blog, so I'll link to that as well if listeners are looking for more information to read through and something to kind of scratch their head and think over. But as always, thank you so much for your time.
Thanks, Samantha.
Absolutely. Once again, that was K-State and Washburn University School of Law professor Roger McEowen joining us for an Ag Law Update.